come back with me. Don't forget to like, share, comment, and subscribe. Can the Fed accept a poor soft landing? Probably not, Brussels said, referring to a scenario in which monetary tightening slows the economy inflation without triggering a recession. It is difficult to envision a winning outcome. Data on August jobs released Friday gave the Fed a bit of a reprieve. U.S. firm added 350 jobs in August, a slowing from the blowout 500,000 jobs added in July. It said that some of the economy's post-academic access may be moderating without giving way altogether. In addition, the number of people in the labor force surged by nearly 8,000 to a new record high. A dynamic Fed official have been banking on the east wage pressures over time because many of those new entrants had yet to find a job. The unemployment rate rose to 3.7% from 3.5%, an increase Fed and other officials are likely to see as constructive since it indicated a greater supply of people willing to take jobs if offered. I don't mind signing and opting in unemployment if we are getting more people into the workforce. That is good for companies, said U.S. Labor Secretary Marty Walsh. We still hear the concern from fear about difficulties hiring workers, but not as loud, he said. Fed officials have the burden of fighting inflation for less unemployment than other parts of the economy haven't. As for months, they have beyond the labor market's current state as unsustainable. The August job report did not ease our thus concern. Average hourly earnings continued to increase at a 5.2% year-over-year pace, the same as the month of before. Fed officials feel that need to slow, with Cleveland Fed President Loretta Mester saying this week she felt wage growth would need to moderate to around 3.25% to 3.5% to be consistent with price stability. Unprecedented Fed officials have been less specific about what will bring things into balance, with some of the working ideas requiring U.S. job markets to act differently than they have in the past. Fed Governor Christopher Waller was pointed to the befagged course, with both the relationship between job opening and the unemployment rate to argue that the labor market could behave differently this time. The current ratio of two job opening for each unemployment person is a record high. Typically, when the job vacancy rate for the unemployment rate rises, as it becomes harder for job seekers to find a match. But Waller argues the beverage curve changed during the pandemic and is in a pace now that would allow job opening to fall sharply as the economy slows, revealing pressure and wages and price without much of a rise in unemployment. We recognize that it would be unprecedented for financiers to decline by a large amount without the economy falling to recession. We are in effect saying that something unprecedented can occur because the labor market is in an unprecedented situation Waller in a research note published by the Fed in late July. Other soft landing narrative also haggled history not repeating helping hand. Okay, that's all from me. Thanks for watching. Don't forget to like, share, comment, and subscribe.